Welcome. Take a moment to slow down. This is not a fast episode. This is not advice you rush through today. We are not talking about charts, numbers, or technical indicators. We are talking about something far more powerful. Something that quietly shapes financial markets. Something that decides who gets access, who enters early, and who stays behind. Today, we're talking about relationships. Let me ask you a simple question. Why do some people succeed in financial markets, even when they do not seem smarter than others? Why do some investors consistently find opportunities before everyone else? Why do certain individuals build wealth quietly, steadily, and almost effortlessly? Often, the answer is not intelligence, not luck, not even capital. The answer is connection, because money does not move on its own. Money moves through people. Financial markets are human systems. Many people believe financial markets are purely mathematical systems. They think markets are driven by algorithms, BRMs on screens, but this belief is incomplete. At their core, financial markets are human systems. Every trade exists because a person made a decision. Every price movement reflects fear, confidence, uncertainty, or desire. Every boom begins with shared optimism. Every crash spreads through shared panic. Markets are not machines. They are mirrors of human behavior, and human behavior is shaped by relationships. Information travels through trust. One of the most important truths in finance is this: information does not spread equally. Some people hear news early. Others hear it late. Most hear it when it is already priced in. Why? Because information travels through trust networks. People share valuable information only with those they trust. Trust is not built through transactions. It is built through time, consistency, and reputation. In financial markets, trust determines who hears first. We gets invitedwo, gains accessio, gets warned before risk appears. Relationships are the channels through which information flows. The difference between public and private knowledge. Public knowledge is what everyone sees. Headlines, earnings report, social media, opinions. Public announcements. Private knowledge is different. It is not insider trading. It is context. It is understanding. It is perspective. Private knowledge sounds like this project is delayed, but not canceled. The management team is strong, even under pressure. Liquidity will tighten before the end of the year. This opportunity is not ready yet. This type of knowledge rarely appears online. It moves quietly through conversations, through relationships, through trust. Wealth is built before it is visible. Most people notice wealth after it appears. They see the successful investor growing portfolio, profitable company, but wealth is built long before it becomes visible. It is built when relationships are formed, trust is earned, credibility is established, a DAX is quietly granted by the time. Opportunity reaches the public. The strongest positions are already taken. Why successful investors focus on people first? Beginner investors focus on assets. Experienced investors focus on systems. Wealthy investors focus on people. They ask questions like, who is behind this decision? Who controls the flow of capital? Who influences sentiment? Who has survived multiple cycles? Because assets change, markets shift, trends fade, but strong relationships adapt. A trusted relationship can survive. Bull markets, bear markets, uncertainty. Good relationship can produce opportunities for decades. Relationships reduce risk. One of the hidden benefits of strong relationships is risk reduction. When you are connected, you receive early warnings, you gain broader perspective. Avoid isolated decision-making. Isolation is dangerous in finance. Many losses happen not because of bad analysis, but because of limited perspective. Relationships expand your view. They allow you to see risks before they become obvious. The cost of the wrong Circled, not all relationships create wealth. Some relationships encourage emotional decisions, reward short-term thinking, normalize excessive risk, amplify. Fear and greed. Your financial circle shapes your financial behavior. If the people around you panic easily, you will panic too. If they chase hype, you will feel pressure to follow. If they value patience, you will learn patience. Wealth is influenced by environment as much as effort. Money follows. Organized networks. Money rarely flows randomly. It flows toward organized groups, coordinated decisions, lined incentives. Large capital moves through networks, not individuals. Funds, institutions, family offices, and long-term investors operate within structured relationship systems. If you are outside these systems, you react. If you are inside them, you participate. Access is more valuable than intelligence. Intelligence helps. Education matters. Skills are important, but access changes everything. Access gives you better timing, better context, better opportunities. Many brilliant people fail financially because they remain isolated. Many average thinkers succeed because they are connected. Building relationships without manipulation. This is important. True financial relationships are not transactional. They are not built by asking for favors. They are built by providing value. Value can be in citrilia benatricis term. Thinking emotional stability. People trust those who are consistent, and trust is the foundation of financial relationships. Long-term wealth is social. Short-term profits can be individual. Long-term wealth is social. It grows inside. Communitas partwalfertions compounds faster when knowledge, experience, and access are shared. Isolation slows growth. Perfect. I will continue in the same calm, professional podcast tone. No interruptions, no part labels. Just a continuous flow. The invisible architecture of wealth. Most people imagine wealth as something visible. They think of houses, cars, charts, balances. But real wealth is built on an invisible architecture. This architecture is made of trust, credibility, rate, term, relationships. You cannot see these elements on a balance sheet. Yet without them, long-term wealth rarely survives. Financial markets reward those who understand this invisible structure. Why markets favor the connected markets appear open, but they are not equal. Everyone can enter a market. Not everyone can access opportunity. Opportunity lives upstream. Upstream is where deals are shaped, narratives are formed, expectations are set, capital is positioned early. Downstream is where prices react, headlines appear, emotions peak. Relationships move you upstream. Without relationships, you are always reacting. With relationships, you are positioning. Social proof and capital flow. Money is cautious. Large capital does not move based on ideas alone. It moves based on who else is involved. This is social proof. When respected individuals commit, others follow. Not because the idea changed, but because confidence increased. Relationships create momentum. One trusted name can unlock millions. One respected connection can reduce perceived risk. Markets respond to belief as much as logic. Emotional contagion. In financial networks, emotions spread faster than information. Fear travels quickly through close circles. Confidence does the same. This is why networks matter. Inside strong networks, panic is contained, volatility is understood, perspect is preserved. Outside networks, rumors dominate reactions. Intensify mist haze, compound relationships regulate emotional exposure. They help you stay rational when the market is loud. Wealth is rarely a solo journey. Stories of the self-made individual are appealing. They are simple, they are inspiring, but they are incomplete. Behind every long-term success story, someone opened a door. Samoyone made an introduction. Somin shared insights. Amin offered trust. Wealth grows faster in collaboration. Even independence is often supported by relationships. The role of mentorship in financial growth: one strong mentor can save you years, not by giving you money, but by shaping how you think. Mentors provide perspective, pattern recognition, emotional control, historical context. They help you avoid repeating common mistakes. Most mentors appear through relationships, not applications. Timing is a social advantage good. Timing is rarely accidental. People with strong networks enter early exit camaragists faster. They sense shifts before confirmation appears. Timing improves when you are connected to multiple viewpoints. Markets reward those who prepare early, not those who react quickly. Trust compounds like capital. Trust behaves like compound interest. Slow at first, it's powerful over time. Each honest interaction strengthens it. Each consistent action reinforces it. Once trust is established, opportunities arrive without pursuit. Collaboration becomes natural. Resistance decreases. Trust attracts opportunity quietly. The danger of short-term thinking circles: some circles focus only on speed. Fast profits, fast exits, fast reactions. These environments feel exciting, but they are fragile. Short-term circles amplify overconfidence, swings, risk, blindness. Long-term wealth prefers calm environments. Relationships that value patience outperform excitement over time. Reputation is financial currency. Your name travels faster than you do. People discuss how you behave under pressure, how you treat others show you respond to loss. How consistent you are in finance. Reputation is currency. A strong reputation reduces friction. A damaged reputation increases cost. Relationships magnify reputation, good or bad. Why silence is powerful in networks. Not everything must be shared. Strong relationships respect discretion. In finance, silence builds trust. Oversharing creates risk. People trust those who protect information. Confidentiality is a signal of maturity. The quiet advantage of listening: the most connected individuals speak less than you expect. They listen. Listening builds understanding. True star: those who listen gain insight before they speak. Markets reward those who observe deeply. Relationships shape risk appetite. Your tolerance for risk is influenced by who surrounds you. If your environment rewards aggression, you become aggressive. If it rewards patience, you become patient. Neither is always right, but awareness matters. Your circle silently calibrates your decisions. Wealth grows where ego is controlled. Ego damages relationships. It creates defensiveness, isolation, poor listening, unnecessary conflict. Strong financial networks value humility, not weakness. Clarity: those who admit uncertainty learn faster. Access without integrity is temporary. Some people gain access quickly, but without integrity, access fades. Financial ecosystems are memory-based. People remember reliability, fairness, consistency. Short-term advantage without integrity rarely lasts. The long game of financial relationships: true financial relationships are built for decades. They survive cycles, mistakes, market changes. They grow stronger with time. Wealth built slowly tends to last longer. Ask yourself quietly: who influences my financial thinking? Who challenges my assumptions? Who expands my perspective? Your answers matter. Power structures inside financial relationships: not all relationships carry the same weight. Some relationships are horizontal. They exist between peers. They are based on shared experience, shared risk, shared learning. Other relationships are vertical. They connect different levels of influence. Capital allocators, decision makers, gatekeepers. Understanding this difference is critical. Horizontal relationships offer support and perspective. Vertical relationships offer access and leverage. Both matter, but confusing one for the other leads to disappointment. The role of gatekeepers in financial markets, opportunity is often filtered. Gatekeepers decide which ideas are heard, which projects receive attention, which people gain entry. These gatekeepers are not always obvious. They may be advisors, managers, senior partners, respected intermediaries. Strong relationships with gatekeepers shorten the distance between idea and execution. Without them, even good ideas wait. Influence is not authority. Authority comes from position. Influence comes from trust. In markets, influence moves faster than authority. Someone without an official title can shape decisions if they are trusted, they are consistent. They have proven judgment. Influence grows quietly, and relationships are how it spreads. Why some voices are heard first. When uncertainty rises, people look for familiar voices. They turn to those who have seen previous cycles remained. Calm under stress, avoided extremes. These voices carry weight because of history. History is built through repeated interaction. Relationships give memory to markets. Financial decisions are rarely logical alone. Most financial theory assumes rational behavior. Reality is different. Decisions are influenced by fear of missing out, fear of loss, desire for approval, desire to belong. Relationships intensify these forces. Strong circles stabilize behavior. Weak circles amplify emotion. The subtle pressure of group thinking. Belonging feels safe, but belonging can distort judgment. When everyone agrees, dissent feels uncomfortable. Caution feels slow. Patience feels weak. Strong financial thinkers maintain independent thinking within relationships. They stay connected without becoming absorbed. This balance is valuable. How relationships shape narratives. Markets move on stories before data. Stories spread through conversations, trusted opinions, repeated beliefs. Relationships determine which stories survive. A narrative repeated by trusted voices becomes reality. Understanding this helps you separate signal from noise. Trust versus popularity. Popularity attracts attention. Trust attracts capital. Many voices are loud. Few are respected. Relationships built on substance outperform those built on visibility. Markets eventually reward credibility. The quiet role of patience. Patience is easier when you are connected. Isolation makes waiting feel risky. Connection makes waiting feel informed. Relationships provide reassurance during uncertainty. They reduce the urge to act unnecessarily. Financial loneliness is dangerous. Many poor decisions come from loneliness. When you decide alone, doubt grows. Confirmation bias strengthens. Fear feels heavier. Healthy relationships provide grounding. They do not remove responsibility, but they reduce distortion. The myth of perfect independence, complete independence, is often misunderstood. True independence is not isolation. It is the ability to think clearly, decide calmly, act responsibly. Relationships enhance independence by expanding perspective. Isolation narrows it. Learning happens faster in trusted circles. Mistakes are inevitable, but mistakes discussed openly teach faster. Trusted relationships allow honest reflection, shared lessons, constructive feedback. Secrecy slows learning. Transparency within safe relationships accelerates growth. How long-term thinkers communicate. Long-term thinkers speak carefully, avoid extremes, acknowledge uncertainty, think in probabilities. They attract similar people. Over time, these circles become powerful, not loud. Why capital prefers familiarity? Capital seeks predictability, not in returns, but in behavior. Investors prefer people who act consistently, manage risk responsibly, communicate clearly. Relationships reduce uncertainty. Reduced uncertainty attracts capital. The emotional cost of broken trust. Trust breaks quickly and heals slowly. One careless action can undo years of effort. Financial ecosystems, remember, This is why restraint matters. Short-term gain at the cost of trust is rarely worth it. Relationships create optionality. Optionality means having choices. Strong relationships create options. When markets shift, when plans fail, when opportunities emerge, options are freedom. Relationships increase freedom. Reframing success. Success is not winning every trade. Success is staying in the game long enough for compounding to work. Relationships help you stay. They stabilize emotion. They expand access. They support resilience.